Hey, good morning, everybody. This is Ken Himmler, and this is my first video on drive time. And why I'm doing this is because I know people have been reaching out to me by comments, by emails, and they're asking me to give more frequent updates. But considering the amount of time, because my job is to take care of the clients in the firm, my time has been very limited. So I thought, hey, I got a good idea. What I'll do is I'll do some drive time video. I used to do these about 5-6 years ago, and people loved them. And I don't know, it's like everything that really works. You try to get sooner or later you stop doing it, right? So today I'm going to talk really about what's going on with the stock markets, because the stock markets have taken a big hit, but it's a big hit off of the top. Now, my main concern today is all of those people that were lured into these money managers that call you on the phone, or there's an internet connection, or however they get a hold of you, and they make promises of great returns. They love to slice and dice the periods of time of when they actually made rates of returns. So recently I had a new client come in and they asked me, hey, what is the difference between you guys and these guys? And I said, well, what are they promising you? Well, they just keep saying that they have made, 24% last year. I said, okay, well, I know this company, and hold on, I got to pull out here, make sure I don't get in a crash while I'm trying to help you. So these companies were promising these great returns, and they were slicing and dicing the information. And I said to this potential client, I said, well, what attracts you to this firm? And they said, well, look at these rates of returns. And I said, okay, two things. One is you have to be very careful when any investment management company is promoting rates of returns. These rates of returns is how they lure people in. And unfortunately, there is an issue where, let's say, they pick a period of time that is preferential to their period. Now, I'll never forget this. I don't know how many Super Bowls ago this was, but I went on and I'm watching the Super Bowl, and all of a sudden there's this mutual fund company that comes up and says, and they show their rates of returns, and in the really small print, they show the dates that they started. So I took a snapshot with my phone of that. It was about 4 or 5 years ago. And I tried to show this to people. I'm like, look at what they're doing. They're literally picking the day, the lowest of the market. You start your rate of return calculation at that lowest point, and then you show what it is at its highest point. Those two dates can make or break you. Now, if they started when the market was at a high, say a period of time before, and then they showed it as an average, it's a whole different rate of return. So that's number one. Be careful of any company promoting their rates of returns. And I tell this to everybody. Rates of returns, depending upon how you invest. So if you invest in, say, exchange traded funds or a managed portfolio with diversification, there is something that is a real thing. It's called reversion to the mean. And what is that? That is where after a period of time, every manager equals the other managers. There is no secret sauce. There is no crystal ball. There's no magic formula. There's no AI that can figure it out. And this is why, Warren Buffett won that bet against the hedge fund company. He bet them after a 10-year period of time that if the S&P 500 beat them, then they would pay $1 million to a charity. Well, they lost. So it would have been simpler just to put the money into an S&P 500. Now, I'm not suggesting that, because you might be in a position where you need the money and you need to accumulate, in other words, distribution phase. And I'm not suggesting you just buy the S&P 500, because if you ever needed the money, the S&P 500 has gone down 65%, which is another reason why you always start how you invest your money with a financial plan. Financial plan dictates how you invest because it's connected to your cash flows. So going back to the dates and times, that's number one. And then finally, number two that you have to be really, really careful of is that what's called the model distribution theory. And what this means is a lot of these big investment companies, what they do is they'll say, would you like conservative? Would you like moderate? Would you like growth? Honestly, most people don't know, and then they make a decision based upon moderate. I mean, this is proven with McDonald's. McDonald's did a study as to, why do 90%, I think it was 86% of people order medium drink. Well, and medium fries, because they don't want something that's too small, but they don't want something that's too big, so they always go center line. Now, McDonald's capitalized on that, just saying, hey, would you like to upsize it for 10 cents? Smart move on McDonald's. But when it comes to investments, can you define what conservative is? What does that mean? In actual volatility metrics, in actual losses or gains in risk, what does moderate mean? Doesn't it mean whoever you're talking to has their definition of safe, conservative, moderate, or aggressive? And I'm going to give you a great example of why that is such an ineffective way of doing it. It all depends upon the personality of the person that you're dealing with, the investment advisor or the management company, how they define risk. So if you looked at an investment company and they said, hey, the S&P 500 is conservative, over what period of time? Now, if I said yes, over a 20-year period of time, there's less than a 1% chance that you're actually going to lose money. Okay, I could say over a 20-year period of time, it's conservative. Now, if I went down under a 3-year period of time, there is the propensity for that S&P 500 to go down up to 65%. I think the lowest point was 65 on intraday trading back in 2008, 2009, and it was horrible for those people that had the wrong plan. So number 2 rule is be careful on the definitions on how you are deciding how to invest, because listen, I'm going to put this in driving terms, because I am sure, like I'm driving here and I'm watching all these crazy people, and there's always, inevitably, there's this guy or gal, it's gender agnostic, I guess, and they'll be weaving in and out of traffic, right, left, right, and you see them putting everybody in danger, but then what do? They end up at the same stoplight as you do. So what was the point of all of that jockeying around? Did they really save time? Did they really get ahead? And unfortunately, this is how people think with investments. They think the more tinkering that they do, they're going to get ahead. So some people will say, well, I want aggressive because I want to make the highest rate of return. But they're not accounting for the volatility. Now, if somebody says conservative, what their internal thing is saying, I don't want to lose money. I don't want to see it go up or down. Yet, if you're making 5% and you're giving 1% to tax, and inflation is 5%, you're guaranteeing a loss every year by 1%. Now, what I find interesting about this is, because you don't see it, it doesn't affect you. This is really money or wealth psychology. And what I mean by that is, let's say, as an example, you get your statement from your brokerage account, you got let's say you got $1 million. You got $1 million in there and the market goes down by 10%, so you lose $100,000. You see that literally, and now you unfortunately see it like intraday. Some of you have it on your phones. Some of you are logging into your accounts on a daily basis. Now, listen, I'm an old guy, I've been doing this 40 plus years. Before the internet, people did not get as freaked out. They were not as worried. They actually lived happier lives, in my opinion, because they didn't see this intraday volatility. So you can log on, you see it, right? So in a lot of people's minds is that causes them pain. If you have pain, you try to stay away from that pain. It's not, the volatility is not pain if you truly understand it and how to work with it and how to segment it based upon the volatility. Now, let's look at conservative. If you have something conservative, we'll use that same example. Let's say you're making 5% on it, you're paying 1% in tax, but inflation is 5%. So you're losing 1% every single year. Why people don't move off of that mark is really simple. It's because they don't see it. See, inflation is like a silent killer. Taxes are a silent killer. Let's walk through the system. You got $1 million and you say, hey, I just want to put it in this 5% annuity. I just want to put it in this 5% CD. I want to put it in this 5% T-bill. Because, now watch, see if you relate to this, because I don't want the risk. I don't want the volatility. And ready for this? I don't want to lose money. Well, that's great, but now let's look through the reality of what you don't see. So now you get you have $1 million. You get your statement, and whether it's a brokerage or bank, and you see your T-bill, your CD, your annuity, great. But you see the value. You don't see any drop because you've invested conservatively. But you have to recognize the outside sources that actually detract from that value. So here's an example. 5%, you got $1 million, 5%, you made $50,000, but you got to give $10,000 of it to the IRS, to the government. Now you're left with $40,000. Why didn't you see that $10,000? Because you didn't see it come out of the account, right? Because you're paying your taxes in a different funnel. So now you still see the $50,000 and you pat yourself on the back and you go, man, I'm so glad I did conservative. Look, the market just dropped 20%. And look, I still have my $50,000. Yet you really don't. You don't have $50,000, you have $40,000. Now let's apply the inflationary effect. Now we know in 2022, 2023, inflation was up 7, 8, 9%. Let's use a historical average of 5%, because that whole 2 to 2.5% true inflation is a giant lie. Because you've got to remember how the government actually computes inflation. They don't include a lot of things. They don't include some housing, they don't include certain foods, and they also have this little thing called an exchange factor. So if the price of filet mignon goes up too much, you know what they do? They swap it for hamburgers. So the inflationary statistic from the government, I don't know, big lie, giant, not true. Now, if you look at what that $40,000 now is worth with 5% inflation, you just lost $10,000. The issue is that they're not showing it on the statement. And if they don't show it on the statement, you don't see it, you don't realize it. But the fact of the matter is, if you try to go buy the same food that you did the year before that would have cost you $50,000, now guess what? You got 40 grand. You not only lost the tax money and you lost against inflation. So what I'm saying is, this market volatility that we have right now, you have to understand how to utilize it. Don't be afraid of it. There is a lot of opportunity in the volatility. And what I would tell you is, if you're dealing with a financial advisor or a money manager that's asking you this ridiculous question of, do you like conservative, moderate, or aggressive? It's probably time to find somebody else, because they don't understand that there is no measurement in conservative, moderate, or growth. You have to have something that you can measure to protect against the risk. And number two is, if you're dealing with any kind of financial advisor or any kind of money manager pitching you investments, you really have to be careful that when you're reviewing their performance, that you're looking at the dates that they're using. Cross-reference those dates with the S&P 500. So if they're using the beginning date at the bottom, but then they're showing you the performance when it's at its top, that's fraud. But there's really no way that you could prove that it's illegal. You as the consumer just have to be careful of the dates that they're using. And finally, and number three, and to shore up today's drive time, is make sure that you understand that what you are seeing on your statement is not always what you're actually making. You have to subtract tax. You have to account for inflation, and you have to account for volatility. Hey, I hope this helped you today, and we'll have to see what the comments are like with drive time and see if this is working out. Hopefully, if you all like it, then I'll do more of these. And so go ahead and leave your comments and make sure that you subscribe and like, because that's how this channel grows, and that's how we get more subscribers and we can start paying for more production time. Hey, thanks. Have a great day.